Good day, everyone. We are here to present our group's assignment about understanding investment environment. Before we proceed to the next slide, let us define first what is investment environment. Investment environment essentially includes all types of investment opportunities, investment vehicles or alternatives in the market that are available to an investor, financial markets, investment process, market structure that enables purchasing and selling of investments, regulatory setup that fosters an enabling environment to invest, and market intermediaries. As we move on to the discussion, we will understand more about investment environment. An investment is an asset or item acquired with the goal of generating income or appreciation. An investment always concerns the outlay of some capital today, time, effort, money, or an asset, in hopes of a greater payoff in the future than what was originally put in. Any medium or technique used to generate future revenue, such as bonds, stocks, real estate property, or business, is considered an investment. In other words, investment or investing means that an asset is bought or that money is put into a bank to get a future interest from it. What are the types of investments? Types of investment are classified into economic investment and investment vehicle. Economic investment refers to the money spent on the purchase of new or replacing the capital assets of a company. For example, a manufacturing company purchased a new equipment to improve production. While investment vehicle are assets offered by the investment industry to help investors move money from the present to the future. Examples are securities, bonds, and real estate. In general, types of investments include stocks and bonds, securities, precious metals like gold, real estate, arts and collectibles, real assets, and others.
The following are the investment objectives. The first one is the safety of capital. There's no such thing as secured and completely safe investments. There is always a risk on it. The safest investment is taking a lower risk, but it is lower in return. The higher the risk, the higher the return of an investment. To keep the safety of the capital that the investor invested, it is not about taking lower or higher risk. It is about choosing the right investment and be mindful of the decisions and avoid being scammed. The second objective is income. Increasing it is always in investors' minds. They sacrifice a degree of safety and taking a higher risk to increase their income. They look for investments where they can get a higher and steady income. The next objective is
Growth, an investment objective for a client seeking a portfolio that can provide for capital appreciation while recognizing and accepting the risk inherent in investment of this type. Growth investments typically generate little or no current income, but have the potential for capital appreciation and may perform differently from the market as a whole or similar investments. With this, increasing the principal value of investments over time rather than seeking current income is common.
Second is tax savings. It is one of the strategies that may help you save money on taxes while also increasing your income. The Income Tax Act allows a taxpayer to deduct different investments, savings, and expenditures made within a given fiscal year. Including tax-saving assets in your portfolio early on offers you an advantage in the future. Furthermore, it allows your assets to begin generating returns over a longer period of time, potentially saving you money at a time when you need it most. Intrinsic value is a measure of what an asset is worth. This measure is arrived at by means of an objective calculation or complex financial model rather than just using the currently trading market price of that asset. It is also called fundamental value, which is established by fundamental analysis rather than market value. It is usually estimated by adding the discounted future income it will generate to get the present value of an asset. Value investors employ a variety of analytical techniques in the hopes of discovering securities with a value greater than the current market value. investors consider two factors. One is qualitative aspect, which includes the company model, market factors, governance, and target. Second is the quantitative aspect, such as ratios, financial statements, and so on.
In the previous slides, the basic concepts about investment has been discussed. Now, we will discuss about various economic indicators that affects the investment environment. By assessing the economic indicators of the country, investors will obtain information that can help them discover new financial opportunities, adjust their portfolios, and ensure that the economy is stable and safe for investment. So, is it safe to invest here in the Philippines? The first indicator we have is the gross national income, or GNI. According to the Federal Reserve Bank of St. Louis, GNI is the sum of value added by all resident producers plus any product taxes not included in the valuation of output plus net receipts of primary income from abroad. Additionally, Investopedia said that it also covers money received from abroad, such as foreign investment and economic development aid. The World Bank states that GNI proved to be a useful and easily available indicator that is closely correlated with other non-monetary measures of the quality of life. And quality of life has become a bigger focus for multinational companies when deciding where to undertake foreign direct investment and indicates that it is stable for investments. In the Philippines, the GNI trend is upward in the past 6 years with $341 billion in 2015, $354 billion in 2016, $364 billion in 2017, $383 billion in 2018, $414 billion in 2019, and $389 billion in 2020. You decide, basing on the GNI of the Philippines, is it safe for investment? Now, let's move to another economic indicator that will help investors in assessing the investment environment, the gross domestic product, or GDP. According to Investopedia, GDP is a metric that measures the production level of a country's economy as it pertains to market value of all goods and services produced within a country. The GDP is a good indicator, especially for those investors that are focused on corporate profit growth, as it reflects how much a country is producing. Although GDP is considered as a lagging indicator, it can be helpful in determining the health of the economy. Analysts can use this to determine if the economy is growing well or it is in a bad shape. The GDP of the Philippines the last 6 years is pretty impressive, with $306 billion in 2015, $318 billion in 2016, $328 billion in 2017, $346 billion in 2018, and $376 billion in 2019. We can see in the graph that the GDP is in upward trend. However, due to COVID-19, the GDP dropped in 2020 with $361 billion. This data translate to an average of 6.49% annual growth rate in the past 6 years. So, is it safe to invest in the Philippines? Be the judge.
Inflation rate refers to the percentage rise in the cost of goods and services in the economy over a period of time, basically the decrease of purchasing power of a unit currency. As reported by the Philippine Statistics Authority, the yearly inflation rate in the Philippines increased from 4.0% in July to 4.9% in August 2021, which is higher than the market consensus of 4.4%. Inflation rates have a mixed influence in the investment environment. With higher prices, the demand for credit rises, which benefits lenders. But with regards to bonds and fixed income, inflation brings an adverse impact. With stocks, however, depend on the performance of the organization behind it. Inflation and interest rates are linked. Higher inflation translates to higher interest rates. Foreign investors are drawn to higher interest rates that would give them a better profit on their investment than they would receive from their local market. This will be discussed further next.
Is it safe to invest in the Philippines considering its interest rates? The Central Bank of the Philippines left the key overnight report rate steady at a record low of 2% on September 23, 2021, in line with expectations and aiming to manage high inflation and uncertain growth outlook. The interest rates on the overnight deposit and lending facilities were also kept unchanged at 1.5% and 2.5% respectively. Around 2% to 3% interest rate is considered acceptable rate for a healthy economy because hyperinflation goes well with this. Low interest rates mean more spending money in consumers' pockets. That also means they may be willing to make larger purchases and will borrow more, which spurs demands for household goods. That is why it is safe to invest in the Philippines.
The unemployment rate is the rate proportion of the number of jobless individuals of working age. According to the National Statistics Office, the unemployment rate in the Philippines dropped strongly to 6.9% in the September quarter of 2021 from 10% in a similar quarter of the previous year, as the economy recovered from the COVID-19 fall. Many are having troubles entering the job market. Unemployment rate greatly affects the economy. Unemployed people spend less money in the market, bringing about lesser economic contribution, and leaves the organization with lower revenue. As the unemployment rate increases, the inflation rate decreases.
That's all for understanding the investment environment. Thank you for watching our presentation.